Hello, hello, hello. All right, we are live. So, whoops, I muted myself. Okay, so we are going to, hold on just a second. I'm trying to make sure. Well, I don't know. I can't do that. Okay, why is this not working? Okay. Okay, we're going with it. All right. Hey guys, I'm BrittanyHanduraRE, real estate agent, coach, and investor. Choked there. I am live every Thursday at 3, and I go on for real estate agents live to do trainings every Tuesday at 9:30. So join me there. But today, what I want to talk about is, sorry. I want to talk about what's happening this week in real estate. There's been some interesting things that have happened in the last couple of days. And so I want to specifically talk about that with regard to real estate and what is going to happen. So I got oh, there's Blueberry. Hi, Bew. So I got, I don't know what's happening. I got a newsletter, a real estate newsletter called The Playbook, and I want to share my screen. So if you're on Instagram, hop over to YouTube because I'm sharing my screen on YouTube. So in this, let me see. Let me make sure. Yes. Okay. Yeah. Okay, so in this newsletter, basically, the weekly housing trends, it says is 6.8% is the average. But remember, the average means that there are some lower and some higher. And so when I looked this morning, it was at 7.08, I think. So almost 7.1. So we're definitely going up from here, and that's the average. So this is something to really stop to think about. What I wanted to figure out was, why is this interest rate going up? What is the cause of it? And so later on, I'm going to ask ChatGPT, and we're going to react to what ChatGPT has to say about that. So stick with me, and we will figure that out together. So let's go back. Why does this take me so long to find? Also, why is it doing that? Okay. So it's saying the median list price is down at 431,000. So in my area, that list price is about double. And what we're seeing is that the list prices are starting to go down week over week or month over month, but not necessarily year over year. So year over year, it's still increasing slightly. And obviously the reason for that is always supply and demand. So there's not enough supply, and the demand, even though the demand is there, it's starting to get a little less exciting or intoxicating for people to buy, because of course, as interest rates rise, it's less affordable to get into a home, especially when you're talking about the median home in my area is $800,000. So, like the average is going to be, you have to have like $500,000 to get into a starter home. So wait, $500,000, $5,000 in a mortgage, if not more. And so when you're talking about that, it makes it so that those interest rates really matter. So when they dropped to 6.5%, people were saying, oh, yay, let's get approved. And now that they're going up to the 7%, it makes it a little bit harder. And now those people are getting priced out of the market. So remember, we talk about this all the time, that if you're a buyer, you don't want to sit on the sidelines and wait for the interest rates to go down, but you also have to make sure that the interest rate is or that the monthly mortgage is comfortable for you. So if the interest rate pushes you to a point that you can't qualify, or that you can qualify, but it would be really, really tight, that's not necessarily going to be what's best for you. And you don't necessarily want to say, well, then I'm out. I'm going to wait until interest rates drop, Because remember, as soon as interest rates drop, that buyer demand goes up. And when buyer demand is high and seller supply, the inventory is low, home prices still go up. So you might still be priced out of that area that you're looking for if you're waiting for the interest rates to go down. So just keep that in mind. You don't necessarily want to wait, but the interest rates are going up right now. The number of listings is at 29.7%, which is up. This is average across the US. So in my area, the listings have gone up slightly. I don't know if it's at that almost 30%, but maybe. I haven't done the math on that to see. But it's interesting to think about that because the listings are going up. That's part of the reason why some of these are sitting on the market for a few days, because now there's more competition. Now more buyers are able to see, like, if I don't like that house, there might be one down the street that is better for me. So you always want to make sure that, like when you're pricing your property, that's part of the strategy that your agent needs to be using, is you need to say that are there other houses around that are priced at X, then you may need to be X minus 10,000 or something like that, because you don't want to be the most expensive home on the market unless it justifies that. But most of the time, if you've lived there and it's not a flip, it is not going to justify being the most expensive. And if you can be a little bit under market and everybody is seeing things a little bit higher, then maybe yours is going to be something that they're more interested in and they're willing to pay more and they're willing to increase how much they're willing and able to pay. So you just have to, you want to work with your agent when it comes to that kind of thing and make sure that you're pricing it appropriately. Okay, so now let's see. I want to go down to, remember, if you're on Instagram, join me over on YouTube because that's where I'm sharing my screen. But let's see. So mortgage rates rose to 6.86 as an average for this week from 6.81. So it went up just a little bit. That's bad, but it's still lower than it was at this time last year when interest rates were at 6.94%. So again, remember, I looked at it this morning and it was at 7.08. So that is higher, but we're talking about like one day and not the average over the week or the month or whatever they're looking at. Let's see. So listing prices dropped by 1% year over year after 9 weeks of remaining flat or rising. So the listings that are coming onto the market, the prices are dropping, and that might be strategic so that people can get those higher prices still. And it might be because we're seeing a little bit of a slowdown, which, remember, even if we're seeing a slowdown, that does not mean that the housing market is falling. That just means that agents are really figuring out where to price it so that the buyers are there's still a high demand and you're going to be able to sell it pretty quickly. But also you as sellers have to also understand that your agent is there to help you close the deal, help you to move on. They don't want to just list all these properties. And so if you are saying, well, I think my house is worth $1 million, and your agent is coming in saying, I think it'll sell for 900,000, it's not going to benefit you to list it at $1 million, because what'll happen is that you'll have to do price reduction, and then you'll probably end up selling it lower than your agent was going to list it originally. So don't think that you are going to get this great deal and because you're starting high, because you've seen that there have been 1 or 2 houses on the street that have sold for that. The buyers determine the price. The buyers determine the value of the house. So you don't want to just go into it thinking, well, I'm going to get the best deal when you're realistically not doing what strategically you should be doing. Houses lingered on the market 6 days longer this week than last year, giving buyers around 50 days to shop around. That's much longer than they had 4 years ago during the pandemic. That is not a realistic thing to compare to, in my opinion, when homes were snatched off the market in a mere 33 days. 33 days. I don't know what market they're looking at, because in my market, it was like in 33 minutes, it was snapped off the market in 2020, 2021. So yes, things are slowing down and they're starting to get to more pre-pandemic levels. And so many people still have the memory of like 2020 in their minds of like, oh, remember when it was like that? And that's just not the reality. That's not the case. Oh, Blueberry's leaving us. Bye, View. Okay, let's see. What's the next thing? Let me find it again. Okay. I don't know why it's doing this. Anyway, it's a me problem. Okay, so this is something I wanted to look at. Price cuts hit a record 10 cities with big discounts. What's funny is that later on in this article, they talk about how big cities are starting to have a boom again. So it's interesting that they're also saying that they have price cuts. So it sounds like this is a lagging metric. Like they had the price cuts, but there is a boom. And so actually, if you're looking to move to a big city, now might be the time. So they're saying that among the 50 largest metro areas, Phoenix had the highest share of price reductions at 37%. And both Florida and Texas have 2 cities in the top 10. So of these metro areas, they're seeing a lot of price reductions. So we have Phoenix, Tampa, Denver, Raleigh, Jacksonville, Nashville, Dallas, Salt Lake City, San Antonio, and Orlando. So of course, what you don't see in there are the much bigger cities like LA, New York, San Francisco, because those are still, I mean, they're just always booming. People always want to be there, always want to move there. So we saw a little bit of a decline in these areas in the big urban cities, and now we're seeing that go back up. So the decline was not enough to make it so that we had to have price reductions and things like that. So if you're in those areas, you're trying to get into those areas, you're probably not going to be seeing tons of price reductions in those areas unless it's really depressed properties or really not even depressed properties, because there are a lot of investors who snap those up. It's more so like properties that just aren't like newly renovated or are not shown well. A lot of times it's just the positioning of the product of the house. It's the listing description, it's the photos, it's the videos, that kind of stuff. If it's taken with like iPhone photos and it's all dark and dingy, you're probably not going to get as great of buyers as if you are doing professional photos. And if you have an agent who comes and is taking pictures on their iPhone, run away. Let me know and I'll connect you with an agent. All right, let's see. So I don't really care. It's saying, what do price cuts mean for investors? I don't really care. Let me read this and see what price cuts mean for sellers. So if you're a seller, listen up. If you're hoping to sell a home this summer, it won't be a cakewalk like it used to be. Many sellers were hoping that the market would take off this spring. Now the numbers show that it's going to stay slow, says blah, 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 blah. Over half of our listings have been reduced, with more about to be reduced. We are now in a buyer's market and sellers are slowly coming to terms with that. I don't agree. I should say in my area, we are not yet in a buyer's market. A buyer's market means that we have over 6 months worth of inventory, and that's not the case in my area. It still is a seller's market. It might not be as strong of a seller's market as it was, but it's certainly not a buyer's market. But that being said, the sellers do need to realize that it's not happening as quickly or as easily as it used to. There's a lot more that goes into selling a home than just putting it on the MLS and those Zillow buyers come and it's sold. You're not having 15, 20 offers. And yet in my area, at least, there still are some listings who are getting 4, 5, 6 offers over asking. So you're still seeing that. It just really depends on the strategy, the type of house, the type of property that you're looking at. And it really depends on the product that you're putting forward, the house that you're actually selling. So again, you want to work with a good agent who's going to know how to position your specific property right. Okay, so let's see. Selling now involves monitoring the market closely. If you hear crickets, it's best to reduce your price sooner rather than later. I do agree with that. Waiting too long to cut can cost you more in the long run. I recently listed a fully remodeled brick ranch in Springfield, Ohio for $219,000. After a few weeks and no offers, we dropped the price and included $6,000 in closing costs to keep the deal alive. Even after you've slashed your price, brace for buyers to smell your desperation. Sellers aren't quite as offended by lowball offers as they were a year ago or a couple of years ago, Fortune says. Sellers will respond with the level of desperation they are currently experiencing, which is growing monthly. So I do agree with this, that there is like a lot of sellers right now are selling because they need to, they have to, because sellers who have a 2-3% interest rate are staying put. They don't have to go anywhere. A lot of these people moved into the house that they wanted to be in or refinanced and got their interest rate and monthly payment to something that they can't even come close to now. And so the people who are selling are people who have to sell. So oftentimes that's going to be if there was a death or a divorce, something like that, where they have to sell, they cannot stay. And the longer you keep that property, the longer those bills pile up. So especially if it's vacant, you're just paying for no reason. You're just paying every month for nothing to happen. So if you put your house on the market and nothing happens for, I always say 14 days, that's a good indicator that it's probably priced too high. If nothing has happened, you have no showings, no offers, no nothing for 2 weeks, it's priced too high and it's time to reduce the price. So that's something that you want to think about. I do agree with that as soon as you start reducing the price, it makes the sellers look more, what we say is motivated. And as the article said, desperate. But that's the reality, right? That's why we say, don't list your price super high to start with. You don't want to throw it out there and then say, hey, let's see what we can get. That is not the best strategy. A better strategy is to price it a little bit lower, because then it will likely sell faster, and then more likely it will sell for higher. So you want to get that urgency. You want to create that sense of that social proof that people want to be there and they're excited about it. And if it's crickets, if there's nobody coming, that tells you something. So that means, hey, it's time to adjust those prices. More than likely. Sometimes it might be a different story, but more than likely that's the story. Okay, so that's the end of that segment. And there was one more from this playbook newsletter that I thought was interesting that I wanted to look at. So this one, luxury homes are a weirdly hot investment. And I say this because in my area, there are lots of luxury homes on the beach. There, of course, in LA, there are lots of luxury homes, all over the place. You don't have to be in Beverly Hills to find the luxury homes. They're all over in California. And so a lot of times the luxury market, it sits longer, but they're not selling at a loss, because most often luxury sellers don't have to sell. They have their house as, a place to park some money. And so they don't have to sell. So when they do, they're like, hey, let's just see what'll happen. And then there's almost always buyers who are looking for the same thing. I want to buy this house just to park some money. And so that's something that we definitely see here in my area. And if for sure in my area, there's a lot of people trying to do Airbnb, because I'm right by the beach. And so there are lots of people trying to do short-term rentals and stuff like that. But this is talking about like ultra wealthy. So let's read what this says. In an uncertain economic time when regular folks are cutting back on splurges, the ultra wealthy are snapping up pricey real estate. The Wall Street Journal found that from February 1st to May 1st, the number of mansions sold for $10 million and up has surged, particularly in Palm Beach, Florida, Miami, Aspen, Los Angeles, and Manhattan. As luxury real estate agent Dana Cook told Wall Street Journal, it's just a safe place to put your money and ride out the wave and see what transpires. So especially in these uncertain times when stocks are going crazy. Stocks are up, stocks are down. They're all over the place. Real estate is usually steadily consistent. Even with the mortgage interest rates going up and down, you're not seeing that. That is not impacting the ultra wealthy. That's not impacting a $10 million plus house. People are paying cash for it. They're not worried about, maybe it's like private funding. They're not worried about like their local bank. The local bank and those people who are worried about interest rates are buying the median homes, the $800,000 homes. And those $800,000 homes, when the interest rate is 7%, that's a big deal. On a $10 million property, you can just say, oh, I'll pay for cash instead. I mean, not me, but some of these other people. Blueberry is trying to get my attention. Okay, let's see. Is there anything else in this that I wanted to talk about in this newsletter? Let's see. The Pope's house is for sale. Right now it's in a suburb of Chicago, Dolton. It's listed for $199,000, but the Pope's election sparked a sudden frenzy of offers. Now it'll be sold to the highest bidder. We'll see what it is. Bought a private island. I don't care about that. We don't care about that. Let's talk about this Lockin Effect. I wanted to read this. Okay. Prison vibes aside, this real estate term refers to a situation where homeowners have locked in a low interest rate on their home loan, making them less likely to put their house on the market when rates are much higher now. Currently, nearly half of mortgage holders are hanging on to rates below 4%. Why would anyone give that up? Ever. But the lock-in effect has been easing. Let's face it, no matter how great your rate is, it's not always possible to stay put forever. Families grow, new jobs require relocation. Plus, homeowners who'd been hunkering down with wild hopes that rates might nosedive again before they sell are waking up and accepting that this dream scenario probably won't happen anytime soon. Although no one knows for sure where the mortgage rates will go next, many predict they will remain above 6% for the rest of this year. As long as mortgage rates don't fly too high, the lock-in effect should continue loosening up. This in turn should help free up home sellers from properties they've been dying to ditch and pass on to home buyers and investors hungry for more options. So, okay, this is basically what we just said. We talked about how the interest rates are going up, and when somebody has a 2-3% interest rate, they don't want to sell. They're locked into that rate, and they feel like it's the golden handcuffs, right? Where like they can't move on and can't go somewhere else. So the interesting thing about that is that what we're seeing is that some people are saying, hey, I was trying to hold off because I want to get into a bigger home. I want to get into something with more land. I want to get into a different area. My kids are getting older, and now I need to get into a place with better school districts. Whatever it is, they're starting to feel like, yes, I do want to make the move. And I'm realizing that interest rates are not going back to that 3%. That's something that's a big deal, and people are starting to realize that. Interest rates are not going to go down to 3%. The only reason we had interest rates, The only reason we had interest rates at that time was because of a global pandemic. That's the only reason we had interest rates that went down that low. We don't want to get back there. We don't want to get back to a time when they have to slash interest rates, because that means that some other part of our economy is going crazy. Now, what we do see is that as crazy things happen with the stock market, that does indirectly impact the mortgage interest rate. So we were seeing as like inflation was starting to look like it was going up, then the mortgage rates were starting to drop. And as the tariffs were being implemented, mortgage rates were starting to drop. Now they pulled back on tariffs. Now mortgage rates are starting to go up a little bit again. I asked ChatGPT about this, ChatGPT. I don't know why I always say this wrong. And it's usually only when I'm doing this. But I asked ChatGPT about this, and I want to see, I actually didn't really read what she had to tell me. So I'm going to read in real time with you. Okay, so let's see. why are mortgage rates rising this week? So what she says is mortgage interest rates have risen this week, with the average 30-year fixed rate reaching 6.86%, up from 8.1% the previous week, according to Freddie Mac. Here's a breakdown of the factors contributing to this increase and what the future may hold. So remember, I said that I just checked and it was 7.08, I think. So interest rates are still like climbing hour by hour. So why are mortgage rates rising this week? Surging treasury yields. So remember, it's not necessarily that they're tied to the stock prices. They're indirectly tied to a lot of that stuff. They are tied more closely to the treasury yields. So mortgage rates often track the 10-year U.S. Treasury yield, which has climbed to 4.6% due to concerns over federal debt and fiscal policies. So when there's uncertainty and craziness like we've seen in the last how long has it been? 100 and something days. When there's all this uncertainty, there is going to be uncertainty in the mortgage interest market too. So what they're saying is US debt is not as good as it used to be. And that's where the mortgage rates are closely tied to the treasury and the bond market. And in the bond market, that's where people are saying, yes, I'll invest in this because the US is such a great place to park my money. Well, if now the US is not such a great place to park your money, our interest is going to be more expensive. It's going to be harder to pay for those things. So that's not a good thing for our macro economy as a whole. US credit downgrade. Here's a big one. And here's one of the reasons why we are seeing this increase in the treasury yield. Moody's recent downgrade of U.S. sovereign debt from AAA to AA1 has shaken investor confidence, leading to higher yields and consequently higher mortgage rates, which is basically exactly what we just said. It's tied to the bond market. And now if our credit rating is going down, that means that people are less likely to be putting money in there. And the other thing too is that just understand that there are like 3 major credit agencies that track this or that report on this, and all 3 of them have downgraded the US in the last like decade. I could be wrong on how soon that was, but Moody's was the final one to downgrade. So US debt is low, and because of all of these new bills being passed and this one giant big beautiful bill that was just passed yesterday, it's only getting worse. Everything's only going up. Our debt is increasing by trillions, more than we've seen in history, and all this kind of stuff. I'm not a political streamer, but I'm starting to get into it. You don't want me to go there. Okay, so anyway, the US credit has been downgraded. That impacts it. Inflation and trade policies. Persistent inflation and aggressive trade policies, including new tariffs, have contributed to economic uncertainty, pushing bond yields and mortgage rates higher. So again, it's all related to the treasury and the bond, not as much to the stock market. And we can still see there's usually an inverse effect from the stock market. But with all this uncertainty, we're going to continue seeing uncertainty. So for people who are ready to buy right now and they're wanting to buy, just know that historically, housing prices have continued to go up, even in uncertain economic times. You just have to be aware and be willing to be in your house for 3 to 5 years. You have to be willing to outlast any dip that does come into the market. Because remember, what realistically is going to happen is if something negative does happen to our economy, they're probably they always do historically, try to lower mortgage housing rates, because houses and housing is the best driver of the economy. So when the housing market is moving, that is a good positive indicator for the economy as a whole. So if they can lower interest rates, then that gets the market stimulated and it gets it moving. But you don't necessarily want to wait until it drops, because that's what everybody's going to do. Everybody's going to be rushing to the market when interest rates drop, and then you likely won't get the same benefit that you were thinking you were going to get. And so you want to make sure that the best time to buy a house is when you're ready. If now is when you're ready and your interest rate is 7%, as long as you can comfortably afford it, it doesn't matter what the interest rate is. Get into the house that you want when you're ready to get into the house that you want. And if and when interest rates drop, then you can refinance. So I'm a big proponent of this, just like refinance once interest rates do drop, because then you avoid all the competition and the bidding wars and having to go higher and all of that. But I only say that if you can comfortably afford the payment right now, as is, with, 6.8% or 7% or whatever it is. So just make sure that you add that little caveat, and know that I'm not saying just get in and just pay all your money and who cares. No, I understand. You want to make sure you're making a very good, sound financial decision for yourself. All right, let's talk about the forecast. So let's look at ChatGPT's crystal ball. Mortgage rate forecast for 2025. Fannie Mae projects that the 30-year mortgage rates will decrease to 6.1% by the end of 2025 and further to 5.8% by the end of 2026, assuming economic conditions stabilize, which of course, that is a big key factor if the economic conditions stabilize. So they're projecting a decrease probably later in the year. I've been talking to some experts, and they're saying that we're probably not going to be seeing a significant decrease in the next quarter, which is going to be the third quarter, right? That's where we are. Yeah. I don't know what month it is. So in the third quarter, there's going to likely be in the third quarter, there is not likely to be a significant decrease. So Fannie Mae is projecting a decrease at the end of the year, at the end of the fourth quarter. Wow. I need to have a snack, I think. Okay, so at the end of the fourth quarter, there's likely going to be a decrease to the low sixes. And then the following year, by the end of the following year, what's it say? Whoops, I pulled up the wrong thing. By the end of the following year, 2026, it could go down to 5.8. So this is not, in my opinion, this is not significant enough to wait on. This is not significant enough to say, okay, I'm going to hold out for 6%, when right now, just a month ago, we were in the 6.5%. So for 0.5%, yes, it's significant. It can help in your monthly payments. It could be a couple $100, depending on your price point. Yes, it is significant and it can help. And keep in mind that you also are betting on something that is assuming that things flatten out and assuming that things calm down. My assumption is that things are not going to calm down for the next 3.5 years. So for me personally, I'm not waiting to get into the house that I want to be in for 3.5 years. I want to get in now, and then let's wait and see what the economy does. And then I can refinance, move, do whatever I want to do. But this is what I personally did. I bought my place almost a year ago when interest rates were high, quote unquote. It's all relative. But when interest rates were at what a lot of people would say are high, I bought my house because I said, what is the monthly mortgage that I can afford? And then if interest rates go down, I'll take advantage of that. Well, guess what? Now, over this last year, I have been able to build equity in my home. I've been able to take advantage of that appreciation that has come. Now, has it been tons and tons? No, but it's been significantly more than the amount I would have saved by that 0.5% that it would have gone down. Does that make sense? Hope that makes sense. All right, let's see what the next prediction from ChatGPT is. So ChatGPT says, Mortgage Bankers Association, MBA, anticipates rates will hover between 6.6 and 7% in the near term, reflecting ongoing market volatility. So same kind of deal. This market volatility is really what is pushing these interest rates, and that's what's dictating the interest rates going up, down, whatever. So they're saying it's still going to go higher. It's going to go into the sevens. So that's something you also want to consider is you want to say, okay, well, if I can't afford it right now, do I want to wait for it to potentially go up? Because remember last year they were talking, was it last year? I was listening to all kinds of experts say, oh, it's going to go down by May. It's going to go back to the fives by May. Was that last year or the year before? Now I don't know. Anyway, there were all these predictions that it was going to go down. It did not go down. In fact, it went up to the mid sevens. So when we're talking about here, like there's uncertainty in this market for sure. But if you know where you want to be, where you want to live, at least you can have some certainty in that. At least you can say, okay, my rent's not going up. I'm living where I want to live. I'm doing what I want to do. Don't wait because you think that interest rates are going to go down. They could go up. And when they do go down, everybody else is going to come to the market and it's going to skyrocket those housing prices. For me, I'd rather take advantage of those skyrocketing housing prices by being into something and taking advantage of that appreciation and my equity growth instead of trying to get in and have a bidding war and outbid other people. And then after that, who knows what's going to happen? Who knows if there's going to be a crash or what? Now, to be clear, we do not see a crash coming. There is no crash on the horizon at all. Most people, I think it's like, I don't know. I have to look up the latest stat. I should ask ChatGPT, but most people have over 50% equity in their homes. So when you have those kind of conditions, foreclosures aren't going to be coming in mass like they did in 2008. We're not going to see those same things. So don't come at me with all of that house crash coming and you're waiting for that. That's nonsense. National Association of Realtors, NAR, expects mortgage rates to average around 6.4% in 2025, indicating a modest decline from current levels. Okay, so that's a little bit of a decline, but they didn't tell us what they think is going to happen for 2026. So overall, it sounds like could go up, could go down, could stay the same. That is a pretty diplomatic answer from ChatGPT, if you ask me, but we'll take it. I mean, you really, in all of this uncertainty, you really cannot be certain. There's no possible way to be certain about all of this because it's so much uncertainty, because we don't know what law is going to be passed, what bill is going to be passed, what executive order is going to be signed. We don't know what, we don't know. It's craziness. But at least for me, I can be sure that I have a home. I'm in my home. I'm good with that. Because remember, if you're a renter, people can just decide to sell out from under you. I was just working on a listing where, it says pause due to poor connect. Oh, we're back. Okay. I was just working on a listing where the seller is selling his duplex and he is kicking out the renter because the buyers want the renters to be out. The renter has lived there for 10 years. That's crazy. That is crazy. 10 years that you've lived somewhere and the landlord can just decide one day, well, I'm selling, so you have to leave. So, like those are things that you have to think about too. Just there's a lot more stability when you are in a home that you own with a mortgage that you can afford. Let me caveat with that. Okay, implications for the housing market. The combination of high mortgage rates and elevated home prices has led to a slowdown in the housing market, with existing home sales declining for the second consecutive month in April. In April, we're in May. Maybe they were saying in April it was the second consecutive month and now May would be the third. I don't know. While some sellers are reducing prices, affordability remains a significant barrier for many buyers. I think that is very true because, like I said, in my area, and I don't live in like a really, really high-end neighborhood. I live in an area that is pretty standard for Southern California. And the median income in my area is $800,000. So your mortgage rates are going to be a lot. Even if you put 20% down, even if you put 20% down, which is $160,000. First of all, how are you getting that much cash when you're a first-time home buyer? Wait, what's happening? Okay, sorry. How are you getting that much cash when you're a first-time home buyer? How are you able to like save all of that if you haven't bought a home? The best way to build that up is by cashing out, selling your home, and then putting that into the next property. So to me, I'm just like, that is really hard for a first-time home buyer. Plus, even if you're putting 80% down, that's still a mortgage. That's still a high mortgage. Let's ask ChatGPT what that is. I don't know what Instagram is doing. If you're on Instagram and you can't hear me, come over to YouTube. But let's go here and let's say, how much would a monthly mortgage be for an $800,000 house with 20% down and down and let's say 6.8 because that's what they're saying it is right now. 6.8% interest rate. All right, let's see what the monthly mortgage would be. 20% down. All right, step-by-step breakdown, $160,000. The loan amount is going to be $640. Monthly interest is 6.5 over 30 years, blah, blah, blah. What is the final result? I don't want to use this formula. I want you to give me an answer. Okay, about $4,000 a month. $4,000 a month and you have to put $160,000 down. So you really have to think about affordability in that kind of context. Like, okay, $400,000 a month. A lot of people are paying that for rent. So, sadly, people aren't like shocked by these numbers right now. I am, but a lot of people are not shocked by these numbers. And when that's the case, you still have to remember you have to put $160,000 down. The other thing is this is not taking into account like the PITI, which is the property taxes, insurance taxes, PITI, property insurance taxes, and what's the last I? Why? I have got to eat something. I don't know what is wrong with me. Okay, so ChatGPT mentioned that it does not include those things. So I want to ask it to include those things, and let's see what the payment ends up being. Can you include those things? Let's see if she knows what I'm talking about. All right, so it's saying they're doing it based on being in California. So property taxes are about 733, 1.1%. So your estimated monthly would be $5,300. They are saying for HOA, they're adding $300 for HOA fees, which I think, principal, interest, taxes, and insurance. That's what it is. PITI, principal, interest, taxes, and insurance. I was forgetting the interest part of it. Okay. So they're saying the principal and interest is going to be $4,100. Property taxes about $733. Homeowners insurance about $100 a month, which that sounds kind of low right now with all of the insurance craziness that's happening in California specifically. And they're including HOA of $300, which is true of like newer homes or gated homes. But even if we took that out, it would be $5,000 a month. So right now it has it at $5,300, $5,316 to be exact. And if we took out the HOA, it would be $500 a month. That is, $500. I would pay that for an $800,000 house. $5,000 a month. You talk about affordability. That is hard for a lot of people. $5,000 a month is a lot of money for a lot of people. So, you think about, especially in California, it's so common that you have to have dual incomes. And like if you have a family, forget about it. You're paying for the daycare, you're paying for kid expenses, you're paying for sports, you're paying all that kind of stuff. plus tack on a $5,000 house payment, you better be making some serious money. So when it talks about housing affordability being a problem, it is a problem. And yet, I mean, I say that, and yet people are still buying these houses. People are paying these for this stuff. People are paying it. I get it. I mean, if you want to live somewhere and you have the means, then by all means do it. But it is crazy. Okay, let's go back up to ChatGPT because I didn't finish before I started asking questions. All right, so let's see. The affordability remains significant. Okay, so key takeaways. Let's see. Current rates, 30-year fixed mortgage are at 6.86%, the highest in 3 months. Short-term outlook, rates may remain volatile, influenced by economic indicators and Federal Reserve policies. Long-term forecast, a gradual decline in rates is expected, potentially reaching around 1.6 by year-end 1.6. Switched it, 6.1% by year-end 2025. I think that is incredibly optimistic. Going down almost a full percent in a year. I've been hearing that and I'm not seeing it. So I don't know. We'll see. Market impact. High rates are dampening buyer activity, leading to increased inventory and potential price adjustments. And this is what we're seeing, like what we were talking about. All of these, there are a lot of price adjustments coming down. Remember, that does not mean that we're in a buyer's market. That just means that it's easier for buyers to get in, and sellers are still selling at a win. Sellers are still winning in this. Don't you worry. They have tons of equity in their homes. They're able to sell their house, buy their next, probably pocket a lot. So they're still winning. When it switches to a full-on buyer's market, it really means that sellers have to really slash their prices and they're not having as much of a spread. Now, that's not always true, of course, in general. It's just something that, like, I'm just saying we're not in a seller's market because the inventory has not exceeded 6 months yet, not in my area at least. And I'm not seeing that in this newsletter that we just looked at today. It's saying 50 days, which is an increase from 30 days. We're not at 6 months. And basically all that inventory means, the 6-month inventory, is if we had 6 months of inventory or if we had all the inventory we had right now and not another house came on the market, we would be out of inventory within 6 months. Now, in a buyer's market, that is higher than 6 months. It's 7, 8, 9, higher than 6 months. In a seller's market, it's lower than that. So what we've seen in the past is that in general, the inventory that we have is about a 2-month inventory, meaning if all the houses that we had were all bought up, nothing new came on, we would be out of houses within 2 months. It's been even lower than that down in like pandemic days. So the inventory being low has made it so that housing prices can still stay steady, even if there are decreasing, even if the list price is decreasing, the appreciation that the sellers are getting is still continuing to go up. So eventually that will come to a break-even point, I should say, and it'll make it so that the sellers are not getting as much of a spread, but they're still, for the near future, I think that the sellers are still going to come out ahead. If you're a buyer, do not wait for that 6.1% that they're saying is going to come in 2025. Because if you do, you're either going to be having tons of competition. You'll have to be putting up you're going to have to get into a bidding war. You're going to have to offer more than what everybody wants. All of these buyers are sitting waiting for that 6.1%. Don't let that be you. Because what you would rather do is get into your house now with a comfortable payment and then be able to ride it out. So right now you could possibly get the sellers paying for a rate buy down. The sellers could pay for you to have a lower rate. It would be great. When it is time for all these buyers to come to the market, the sellers have the upper hand. They're not giving anybody any kind of credits. They're not going to pay for any rate buy downs. They're not going to be paying for anything like that. So just keep that in mind, that your strategy is important. So make sure that you're talking with an agent who understands this type of strategy, whether you're a buyer or a seller. If you don't have an agent that you're working with, reach out to me. I can connect you with a good agent all across the country. And that is it for today. We are going to be back next Thursday at 3. And remember, for real estate agents, I do trainings every Tuesday at 9:30. So jump on with me live on Zoom there. And of course, follow along on YouTube. That's where I have all my best stuff. So go on to YouTube and check that out. And I will see you next week, next Thursday at 3. Bye.